The U.S. office market recovery maintained its momentum in the final quarter of 2014, in line with the stronger growth of the U.S. economy that we've seen since the spring. With U.S. companies adding jobs at the fastest pace in a decade, demand for office space has approached levels not seen since 2007. Q4 marked the third consecutive quarter with positive net absorption of at least 15 million square feet. That's a big step up from the 7 million square feet quarterly average logged between 2010 and 2013. With companies taking more space, vacancy once again fell, dropping below 14% for the first time since mid-2008. Rents continue to climb, with the national average rising for the 15th straight quarter. However, despite the steady growth, we're still more than 2% off the all-time high. New supply levels continue to increase to meet heightened demand. However, the amount of new supply coming online nationally was still only about half the long-term average. Vacancy rates continue to edge down across the U.S., with 74% of markets tracked by CBRE Research posting declines in vacancy during the fourth quarter. Western markets led the way. San Jose saw the largest quarterly drop, falling 160 basis points from Q3, followed by Salt Lake City, down 140 basis points, and Oakland and the Inland Empire, both down 120 basis points. Among the major markets, the picture was a bit more mixed. Half of the 10 largest metros actually posted increases in vacancy during the third quarter, with 30 basis point increases occurring in Dallas-Fort Worth and New Jersey. However, only 2 of the top 10 markets, Dallas-Fort Worth and Washington, D.C., were up on a year-over-year basis. Job growth and increased investment by business are 2 key drivers for the office market right now. 2014 was the strongest year for the U.S. labor market in more than a decade. Office-using employment grew 3% over the course of the year and accounted for 30% of all jobs created nationwide. While occupiers are doing more with less, reducing the square footage they occupy per employee, more and more organizations are no longer able to accommodate their growth within their existing footprints and are entering the marketplace for more space, buoying demand in the process. Business investment is also propping up demand. Expenditures on equipment and intellectual property increased materially in 2014. These expenditures are consistent with a greater willingness we've seen among office occupiers to make capital investments in their facilities. In many cases, this means upgrading their office space as part of workplace strategies that utilize mobile technology and creative design to retain and attract talent, foster collaboration, and maximize efficiencies. All signs point to a healthy 2015 for the U.S. office market. Construction will pick up to meet the increased demand. Heading into 2015, 20 markets recorded development activity equaling at least 2% of their standing inventory. Yet, demand will easily outpace supply, which will result in tighter, more expensive marketplace for the occupiers. Energy-centric markets like Houston, Denver, and Pittsburgh will have to grapple with the ripple effect of lower oil prices, which are forcing many energy companies to scale back. However, real estate metrics tend to lag market events, which means it will be a quarter or so before we'll actually be able to gauge the actual impact on the market. The capital markets will remain very active, as the perfect storm combination of low interest rates, healthy leasing fundamentals, and steady GDP growth will continue to draw in both debt and equity sources. While the stronger dollar can impact the migration of foreign capital into U.S. real estate, the huge pool of domestic capital targeting gateway markets should counterbalance any fall-off.